G'day everyone, my name's Michael Baragwanath. I'm the Managing Director at Clime. I'm sitting here with the Founder and Chairman, John Abernethy. And today we want to have a bit of a chat around the sort of private credit market, or the shadow banking market as it's sometimes referred to, and just some general views on how we're tackling that sector, what we're seeing in the market, and how that sort of interacts with other areas in our economy. So John, you've been around for a while. What do you think of lawyer loans and private credit?
Well, you're right, they've been around for a while, and the asset class of private credit and private debts has grown. I think we've done a previous video where we talked about the banks being controlled by regulators in terms of capital allocation and therefore asset allocation against that capital. In Australia, it's well documented that the big banks have adjusted their assets, which is their loan book, to be substantially housing related, residential related, with mortgages, first security. The business sector, and particularly the small business sector and the property development sector, has been starved of bank debt. So it's gone to another avenue, which is the private debt market, private credit market. It's not only in Australia, it's worldwide. And we at upcoming presentations we'll go through this, that Australia is a small market. It looks like a big market in terms of hundreds of billions of dollars, but in terms of the world market and in terms of what it could be, it's still a small market, and given that we have $4 trillion in super. But the development of the private credit market has created a vertical, an asset vertical for retirees or superannuation funds to invest in. And that's what is being grappled with, because the demand for high yield is substantial. The banking sector and term deposits and low risk investing doesn't give you a yield substantially above inflation, and we've got inflation creeping up as we've seen recently. So my point is it's a legitimate market. The question is, how do you find practitioners in that market who know how to manage that capital and get a return on it and get the capital back?
Yeah, and you'll notice I didn't interrupt you that time. That's because right. I've been called out for it before, and I managed to get all the way.
I might interrupt you now.
Well, you can. I feel like you owe me a few. Okay, so just to build on that, it's a challenge and something we've seen, because this, and I've had these conversations with politicians around this, especially when rates were a little bit lower, when they were sort of saying, oh, the market's really good, the cost of credit's really low. And I sort of went, well, that's only true in a very specific set of circumstances. But when you're in small business, medium business, or you're in development, construction, land holding, all of these other areas, the cost of capital has been significantly higher than the Reserve Bank rate. So, if you own a shopping centre and you've got a stack of tenants, the bank will be lending you at, bank bill swap rates, so BBSW, plus say 70 basis points. So the RBA rate plus a small margin plus around 70 basis points, as low as you can get it within reason. If you're in building a land subdivision, then you just basically won't get a loan, and you'll be paying 10 to 15% interest rates. So credit card interest rates for the average mum and dad on land subdivisions. And so when you look at the cost of housing and the cost of land and the affordability of housing, well, one area that's been driving that up is that anyone who's doing land subdivisions is borrowing from private creditors. And their whole business is quite, I'm not going to say murky, but it's quite complicated, and it's very hard to account for. So I'm not going to name them, but recently there was a very large funds management group that there was a question set asked about them, and as a result there was redemptions. So people were concerned, the questions were asked. But the challenge with that sector is there's always challenges. So how do you account for the fact that the documents are set up almost to leave a person in default? That's very much what happens with a lot of private lending arrangements, is anything goes wrong, they're in default. Now, there are two ways you can account for default. You can either account for the accumulated interest you're going to receive, or you can discount the principal on the basis that you might lose capital. And both those answers are kind of wrong, because often when you resolve a loan that's gone into default, first of all, you have an asset security, so you have a real asset you can sell, which is why it's typically seen as less risky, but you can't immediately sell it tomorrow, so it's very illiquid, which is a challenge, because people sort of, when they see concern, want to redeem, and you can't do that if you've got a borrower who's legitimate, who's paying their bills. And then on the other side, if you have a default, you can't necessarily count all of that interest and say, oh, well, goody, we're getting all this extra return, because often you'll negotiate an outcome that doesn't charge them the default interest if you're reasonable. So all of these things create accounting tripping points, create management tripping points for fund managers, and while the opportunity is good, the complexity around it is tremendous and very difficult to manage.
I think I'd lead on, going to another point. When we look at the asset classes, like direct property as an asset class, developed very quickly for self-directed retirees and for major super funds, and as it should be. Investing in property, I think I remember doing a presentation when you looked at the top 150, the highest wealth in Australia, about 2/3 of them created their wealth out of property and holding it long term. So it's worked over a long period of time. But what we've seen probably since the GFC is the growth in direct property trusts. So this is off the ASX, so direct property trusts and syndicates, attracting investors as it should, getting quite attractive yields. But unfortunately, I think as we've gone through the cycle and into COVID, interest rates have been all over the place. The Australian economy has been not growing consistently. There's been issues are in Perth, Adelaide, Hobart, which lags substantially behind the East Coast. So then you've had the industrial cycle develop, because it was very much the takeaway of industrial land put into residential land. So we had a surge in industrial property, so that was the best place to be. There's been some recovery in agricultural property. But if I look at investing in property, my rule of thumb, looking back over 15 years on experience, 10 direct property investments across different sectors, probably what we're seeing now is one or two of those equity property trusts having no return and having a substantial negative return. Then you look at, there's about another 3 or 4 which are given an adequate return. I'd say an adequate return would be 10% plus internal rate of return. And then another tail where they're going to work through, probably get the investor their money back, but with very substandard yields. Compare that to direct property lending, okay? And that's first mortgage lending. If I had the same 10 types of investments, you'd have virtually all of them at no capital risk, okay? 9 of them would have all their interest paid. One might be in some sort of workout where there's penalty interest paid and maybe an equity position secured. The return profile on lending to property appropriately is completely different to investing in property. Now, we notice in retrospect, the yields are better and actually the risk is lower. And given the loans are between 6 months and 2 months in duration, as opposed to a direct property fund, which can be 5, 7, 10 years in duration, the liquidity issue is much less. And our view, and putting this to clients 6 and 12 months ago, I remember saying it in presentations, it's very hard to justify direct property when you're getting a better yield on lending to the property with more security. And we, as a group, we're going down that route to try and develop expertise to provide better credit deals, better property credit deals than direct property. And I think that's where the market is. And I think most property fund managers in Australia have developed property credit asset classes. They're actually building their own funds. So I think there needs to be a little bit more understanding about what's going on in the property market and the lending against property market. And I think there's a lot of spooking going on in the market. There's something strange going on. No, the banks have withdrawn from the market. There's a lot of money in super. If management teams can be developed to appropriately lend on security and get a pretty well certain yield, over a 1 and 2 year period, there's nothing wrong with that. And we don't want to spook markets to upset them and create a problem we don't have.
Well, we end up with a minor credit crunch,
That's right.
to be honest. And there's actually, I'm not going to say there is a risk of this, but there is certainly the elements of a risk of a minor credit crunch in certain circles of development and construction in Australia at the moment, because that's exactly what happens. So, $1 billion being taken out of another fund, for example, that's $1 billion that's not going into another credit arrangement. That's going, I'm concerned about the sector and I'll pull out. Now, that's quite a lot of housing and other construction projects that won't occur because that money can't be deployed. And I think what's got to be pulled apart here is, in my head, from a macroeconomic perspective, we've stuffed up our regulation regime, and banks used to protect investors from this. So banks would run a whole series of different loans, from home loans to business loans to construction loans, and they would wear that collective risk. Now, the concern was that banks would then be exposed to systemic risk. So, the whole point of introducing Basel III and restricting banks' credit lending potential was this idea that if they took on too many construction loans and they all went bad, it could actually cause the bank to fail. And of course, being from South Australia, I know that because our bank did fail and the state government had to bail it out. Now, the people around at the time actually blamed Victorians, but that's what we South Australians typically do. We blame Victorians. That's the way we work.
Well, a New South Wales guy was called in to fix it. I used to work for at NRMA many years ago, so he was the best insurance manager in Australia and became a very great credit manager, but that's by the by, that's historical.
Yep. But so the point is, to protect against that risk, we've separated it out. So now we have a private credit industry that was really largely taken care of by the banks. The challenge is the cost of that credit and if you like, the inefficiency of the way that's deployed has driven up the price of construction across every level, really, because the cost of capital now is not bank rates, it's 8% plus. Now that's a great return for investors. So we've got these macroeconomic challenges, but then as investors, we need to create those opportunities for our clients, because we'd be crazy to say, let's just go into property trusts when property trusts right now are delivering returns less than what we can achieve with private credit in a more secured position. They're both rather illiquid, and that's the other part to work through as well. If you go into these transactions, how easily can you get out? And the beauty of them normally is the duration sort of up to 2 years. So it's not 5 to 7 years. And the other point is that as the credit provider, you always have the option of calling in the loan when they expire. So we've actually seen this a few times with property trusts when they expire, but it's in the interests of the manager and everyone else to just roll over and keep everyone stuck rather than actually selling the property. And selling the property would create a loss. So then the position normally becomes pretty prudent to just say, well, hold it and hopefully time will heal the wound. With credit, you have the option of simply saying, well, if we've lent it a 70% loan to valuation ratio, we've got 30% of equity to recover our position before we are even worried about a potential loss. Well, we don't have to wait. We can just sell it. And that forces the borrower to go find another way to refinance or something else. So it's a challenge on a macroeconomic perspective. It's an opportunity on an individual client perspective. And it's actually been something we've been using to boost the yield of CAM. So what we did, and for anyone that's we need to make sure we've got our advice or general advice disclaimer all over this video because we don't often talk about our own solutions, but CAM's a listed investment company. CAM borrows money from investors under a note. We deploy that money into unlisted debt. The margin, the difference between what we borrow for and what we lend out, goes to the equity investors. And what that's doing is boosting the yield that our equity investors could otherwise achieve. So those little strategies are the types of things we do to boost our capability, deliver unique solutions, and improve returns ultimately. And
there's a very good explanation for this in the annual report in my chairman's letter. I actually explained it in great detail. And the result is we have a very good dividend on our Clime Capital shares. At current market, we're heading towards 10% pre-tax. Now, that's an opportunity maybe, so you make your own decision up. But if you hold it, again, please talk to us to understand. I've had some phone calls from Clime Capital shareholders who are wondering about the share price. And we're happy to do that. So, but we have an AGM coming up as well in a couple of weeks, and obviously come along, ask your questions, but our yield in the market now is one of the highest. We're trading at a 15% discount. I have no concerns with mortgages. I mean, as I said, if you lend out $1, that dollar's going to come back with the yield. You invest in a property trust, you put $1 in, you find out in 7 years whether you get your dollar back. So in my world, it's a much lower risk type of investing at a much higher return. And concurrent with that, and we've reported this to the market, the equity portfolio run by Steve is going fantastic. We're outperforming the market and our peers and generating good franking there. So
and now we're becoming a bit more of a product podcast. We normally just talk about macro.
Well, the macro will come out later in the week, but just commenting. We've had the APAC forum. We've had Trump negotiating still. I think it's obvious, just to close on this aspect of it, I think we can now see the game plan clearly from Trump. Create a problem.
Yep.
Say it's difficult to solve and then negotiate away and look like you've come up with a solution for a problem which actually didn't exist a year ago, which you created. It's quite clever. Gets him a lot of media. I don't know why he wants media. He's the president. He's not up for re-election, but he's creating quite an issue. Good that the Australian Prime Minister had the meeting and the terms of whatever it was we were negotiating. In terms of rare earths, that's good stuff, and we'll stimulate investment in that aspect of it.
One one other thing, and I did interrupt you, but
Okay,
sorry.
no, please.
So we've discussed before this idea of the fact that we've got such a large superannuation pool, right, and that it's not really being deployed appropriately into assets in our economy. Now, Jim Chalmers recently came out and said we should be deploying our $4.3 trillion into our economy and talking about how they do that. Now, it's interesting when we make that commentary as market participants, but when the government does it, it's quite scary for a lot of people because then it becomes, well, why is the government going to touch my money? And it becomes an ideological play. You've had some thoughts on how government can direct or you have some sort of influence on this. Did you want to talk to that?
Yeah, look, 2 points. And, let's remember also in the Prime Minister's meeting in the US that other ministers went along, and I think some of the super funds went along, and there was some off the side statement that Australian super funds were sort of making some soft commitment to invest well over $1 trillion in America in the next 10 years. So let's just be clear, that was a strange one. But look, I think there is a way that the Australian government can connect opportunity with the long-term investment in super. That's creating infrastructure bonds, whether it's particularly house building, where the money comes in, gives the super funds who should allocate the bonds as part of their balanced investment portfolio, and more so as more and more baby boomers retire and will require stable income at lower risk. So an infrastructure bond which pays Australian super funds only, so you've got to be an Australian resident, so you can't be a foreigner, 1% to 2% higher yield on a government bond. Call it an infrastructure bond, 10-year term. Towards the end of that term, the holders of the bonds, which may be big industry funds or large retail funds, can look at the underlying asset and determine whether they want to take the equity in the underlying asset, which will hopefully generate a higher return going forward, or redeem their money and then do a reset in a new infrastructure bond. I think there's got to be a connection between, government policy, long-term planning, economic growth, the government appropriately involved, public-private partnerships, and the immense equity we have or capital we have in the Australian superannuation system.
How do you think we address that with the political, machinations that surround it? So there's a lot of concern around saying, well, the government's going to take people's super and throw it into green energy. And, we need energy infrastructure, we need to bring energy prices down, but there's ideological constraints around, forcing it into unproductive means. That's so we sit here and go, we should be deploying our superannuation better. Yeah. But at the same time, if the government's doing it, are they going to allocate it to the most effective or productive use, or are they going to allocate it to the most ideologically aligned use?
Well, we just had a round table, which has gone nowhere. I have said and written that we need to have a vision. I don't want to use like a China vision or an Indian vision or a Singaporean vision, but this country needs a vision. What does it want to achieve by 2035, 2050? Once you agree, and the Parliament agrees, then it's up to the political parties to work inside that vision to get to the end point. Now, the allocation of capital from the superannuation system through direction of government or through infrastructure bonds, the performance will be determined and reported upon yearly, is my point. So these round tables shouldn't just be a think tank and then we see you again in 4 years' time. They should meet every 6 months and see whether Australia is on the pathway to achieving its long-term plan. Then it can be adjusted. Now, whoever's the government, then goes back to the people every 3 months and reports on progress against that plan. And the opposition, whoever it is, can say, we can do it better by doing this. Without having that plan, you have quite a poor political debate. There's no vision. And I think we need to get away from personality politics and sort of like bubble thoughts, which I think are everywhere, to get a national vision. And look, is Singapore the greatest place in the world to be? But they seem to have done bloody well in difficult situations, and they seem to be a happy society with a high standard of living and low tax rate. So I think we need to learn from overseas, adopt significant public policy and planning, work inside it and fund it with the immense capital we have. So the protection, when people say the protection against government, is we have I'm not happy with a 3-year election cycle, I'd like it to be 4, but the people ultimately vote. And if we get smart people in politics who can argue the case for public policy development and a vision for this country, I think the whole voting process will be the corrective mechanism to ensure we do it properly.
Well said. Brilliant. Well, I've only managed to interrupt you once this time. Sorry,
I think it was twice.
Twice, you reckon? All
we
right.
just did it again.
We will. We will hear, because we will get the comments.
Yeah, we will.
All right, brilliant. Well, on that note, we'll close here. But thanks again, everyone that's watching, listening. And if you've got comments, we do read them. We do reply to them. So thanks again for your time.